Hi guys, welcome to another video. So in the last video, in the first part, we discussed about the automobile financial model. It's a revenue builder, and in this video we are going to discuss about the cost sheet and other parameters of the automobile industry. So let's come to the sheet. So this is the cost sheet for the particular model. So this is the sales. We link with the sales number of the particular company. Then we have the direct cost. It's a cost of material consumed. So generally, in the manufacturing of the car, we use the material, and this is the cost of the material we generally consume during the financial or during the manufacturing of the cars. And this is the particular percentage of the sales. Let's say 52%, 59%, and 57% is the cost of material consumed. Then we have the purchase of stock in trade. So it's around 3%, 2%, 4% of a particular company. Then we have the changes in the inventory of stock. So it's a 1% or 2% of the particular company. So this one is that. Then we have the indirect cost. It's employee benefit expense. So it's 11% of sales and 10% of the sales. So this one is there. So this one is there. Then we have the finance cost. It's a percentage of sales. It's a 0.23% and 0.17% of the sales. Then we have the other expense. It's a percentage of sales. It's a 17 or 16% of the sales. This is the other expense. Then we have the cost of manufacturing or purchase the product capitalized. So it's a 0.30, 0.39 and 0.34 percentage of sales. So this one is that. So this is the total indirect cost of the particular company. Then we go into the next schedule. So it's about working capital management, or we can call it a different schedule for that. Let's say we go into a different one, but we start with the working capital management. So this is a working capital management. So this is the net sales. Then we have the cost of sales. So it's a excluding the another indirect cost. So it's the cost of sales. Then we have the working capital balances. So it's a current investment. Then let's click on this. So this is the current investment of the particular reason. Then we have the inventory, and then we have the trade receivables of a particular reason. This is a short-term loans and advances and other current assets. So this is a you know investment, or you can say that it's a short-term or long-term, something like that. Is a working capital balances. Then we have the non-current assets balance or the current liabilities. It's a trade payables that are linked to the balance sheet. And then we have the other current liabilities and short-term liabilities. And this is linked to the this one. It's a trade payables or trade payable days. So this is the net working capital deficits are there. Then we go into the depreciation schedule. So it's on the basis of different parameters and the different methods. Let's say this is net sales, and this is the total expenditure year on year, and this is a percentage of total expenditure we are working right now. Let's say this is the beginning PPE, and after that we have the capital expenditure. Then this is the depreciation schedule, and this one is the end of PPE. So it's a total of both the scenarios. So it's a total of opening balance capital expenditure minus depreciation expense asset sales or the ending PP value. So it's a PP breakup for that. Let's say freehold land, this one is 26,135, leasehold land 5299, building freehold 39884. It's a total 3.4%, 16.9%, 25.7%, and 48.2%. So this one is that. Then we have the total capex. So it's a freehold land, total capex, percentage of particular asset in the different cases. So this one is that. Then we have the leasehold or straight line method. So it's a useful life is 62 years and leasehold land is 5299. Then we divide it by this. So it's a per year depreciation. Then same for the building freehold as well, and same for the building leasehold as well. So this is going to be different for the different one. Why this is average? So this is average on the basis of different parameter. Let's say you value the company in the mid of the year. That's why in the first year we are taking this average. From the next year, this is a full year depreciation, because uh, in the next year we are going to calculate this for from the starting to end of the year. So that's why it's a full year. So this is something about that financial model. In the next video we're going to discuss about the full financial model and another schedule. If you like the video, you can subscribe the channel or like the videos. Let's meet in the next video.